Welcome back to the Deep Dive. We're here to sift through the corporate reports and find those nuggets of real insight for you.
That's right.
Today, we're putting Dime Community Bank shares under the microscope. That's ticker DCOM after their Q2 2025 earnings call.
And the initial market reaction was pretty interesting, wasn't it?
It was kind of a confident but measured upward move in pre-market.
Yeah, not a huge pop, but, more like a steady nod.
Exactly. Suggests investors are looking past just the headline numbers, maybe?
I think so. It signals they're actually digging into the strategy, the underlying trends, and seeing something positive taking shape.
So that's our mission today, right? Unpack what's driving that sentiment, look at the core results, sure, but really get into the strategic moves Dime is making.
Definitely. The why behind the numbers.
Okay, let's kick things off then. Quick snapshot of Q2 results. Core EPS came in at $0.64.
Which beat the street by about 1.6%. Not massive, but solid.
Right, but the momentum is what stands out to me. Up 12% from Q1 and a really impressive 49% jump compared to last year.
That year-over-year number is significant. Shows real acceleration.
And it wasn't just the bottom line, was it? Total revenue, so that's net interest income plus non-interest income, hit nearly $109.7 million.
Yeah, also beating estimates by about 2.6% and up, 22% year over year? Huge jump.
And the engine room for a bank, that net interest income?
Saw really robust growth, 30% quarter over quarter. That's powerful.
30% Q over Q is serious. But I'm also looking at their core pre-tax, pre-provisioning income, the PTPP.
Yes, the core profitability before taxes and loan loss provisions. A cleaner look at operational strength.
Exactly. And that surged to $49 million. That's up from $28 million just a year ago. What does that tell us?
Well, it screams efficiency gains, right? And operational leverage. They're getting more profit out of their assets.
Which translates to that core return on assets, the ROA.
Right, 85 basis points on a core basis. For every $100 in assets, they're generating 85 cents in that pre-tax, pre-provision profit. Pretty healthy.
And the all-important net interest margin, NIM, the core profitability measure.
Improving again. Fifth straight quarter. Hit 2.98%.
Okay.
And even if you strip out some noise like prepayment fees and purchase accounting, it was still 2.95%, up from 2.91% in Q1.
So consistent upward movement there. That doesn't just happen by accident?
No, it points to some fundamental drivers working in their favor.
And underpinning all this, you mentioned strong capital.
Absolutely. They call it best in class, and honestly, it's hard to argue. CET1 ratio of 11.25%. Total capital at 15.8%.
That's a serious buffer.
Huge competitive advantage, gives them flexibility.
Okay, so those are the headline numbers, pretty compelling stuff. But let's do the deep dive now. How do they keep this going?
Right. And it really centers around that net interest margin, the NI, and this almost built-in tailwind from asset repricing.
Management sounds pretty bullish on this.
Very bullish. They see a gradual upward bias in Q3 NIM and then a more pronounced expansion in Q4 as this repricing really kicks into gear.
And the numbers behind that bullishness?
It's substantial. We're talking about roughly $1.95 billion, nearly $2 billion of adjustable and fixed rate loans.
Okay.
These are currently sitting at a weighted average rate of only about 4.1%.
Pretty low in today's world.
Exactly. And they're scheduled to reprice or just mature in the second half of this year and through 2026.
So rolling off the books or getting reset at higher rates.
Precisely. And just that rollover, that repricing event could potentially add something like 30 basis points to the NS.
Wow, 30 basis points just from the existing book turning over. That's significant.
It is. It's like finding profit without having to chase new business aggressively. It's baked in.
That provides a nice cushion, doesn't it? And it doesn't stop there, you said.
No, there's another chunk, about $1.7 billion worth of loans, currently averaging around 4.25%, set to reprice in 2027.
So this tailwind extends further out.
Right. It supports continued NM growth beyond 2026. Plus, they reminded everyone, historically, a 25 basis point Fed rate cut usually helps their NIM by about 5 basis points.
So Fed cuts could actually accelerate this.
Interesting. Could be another tailwind, yeah. Near term, though, the focus is on that loan repricing. About $400 million in Q3, mostly late in the quarter.
Okay.
And another $200 million in Q4.
Got it. And the ultimate goal here, where do they see NIM going?
Management's setting markers. First 3.25%, then maybe 3.53%. They're aiming for structurally higher profitability.
A clear roadmap. But they're not just sitting back and waiting for loans to reprice, are they? What are they doing proactively?
Good question. That's where the strategic expansion comes in. They're actively pushing into new lending verticals.
Higher margin ones, presumably.
Exactly. Things like corporate finance, lender finance, and fund finance.
Okay, what kind of spreads are we talking about there?
Attractive ones, around 250 to 300 basis points over SOFR. That's a healthy margin they're building in.
And diversifying revenue streams at the same time? What about the risk profile of these new areas, like fund finance?
Well, fund finance, specifically the subscription lines part of it, is generally seen as a pretty low-loss business. So they're aiming for higher returns, but seemingly with a good handle on the risk.
Have they done this before? Moved into new verticals?
Yeah, they pointed to their healthcare vertical as kind of a template. That's grown to $350 million in balances over the last couple of years.
Okay.
So the plan is similar. For these new verticals, aim for maybe $300 to $500 million each over the next, say, 2 to 4 years. Build out a diversified, high-quality asset base.
Makes sense. And expanding physically, too. New branches.
Yep. Got approval for a new branch down in Lakewood, New Jersey, and they expect to open a new Manhattan branch in Q4 this year.
Okay, so product expansion matched by geographic reach.
Bringing them closer to new clients.
And all this growth needs funding, obviously. How's the deposit side looking?
Pretty strong, actually. Core deposits were up $1.21 billion year over year. That's solid growth.
And the non-brokered deposits, the stickier stuff.
Up about $210 million quarter over quarter. But interestingly, they also proactively cut a $125 million municipal relationship that was likely higher cost.
Ah, so managing the funding mix.
Exactly. If you adjust for that deliberate reduction, the underlying non-brokered growth was more like $335 million. Shows they're actively optimizing.
And the teams they've hired are delivering.
Seems so. Deposit teams brought on since 2023 have grown their portfolios to about $2.2 billion combined.
Impressive. And the cost of these deposits, is it creeping up?
Surprisingly stable. Cost of total deposits was 2.09%, basically flat compared to Q1.
Flat cost despite rising rates and strong inflows. How?
Good inflows across the retail network. Private banking added 1,500 new accounts in Q2. Plus, they expect deposit opportunities from these new lending verticals, too.
Okay.
But management was clear. Unless the Fed cuts rates, the main driver for a NIM expansion is going to be that asset repricing, not necessarily cheaper deposits.
Right. Underscores how crucial that repricing story is. Okay. Moving beyond margins. Let's talk overall growth and that commercial real estate, or CRE, ratio. Sounds like there's a bit of a balancing act going on.
Yeah, they called it a tale of two balance sheets, which I thought was interesting.
How so?
Well, on one hand, business loans are growing nicely, up over $110 million quarter over quarter, over $370 million, or 15% year over year.
Solid business lending.
Right. Originations, including new credit lines, hit $450 million at a weighted average rate around 7%. And the pipeline looks strong, too. $1.22 billion at about 6.85%.
Okay, that's the growth side. What's the other side of the tail?
The other side is strategically managing down their CRE concentration. They're aiming to get that CRE ratio near 400% by the end of the year.
So deliberately shrinking CRE exposure.
Or at least letting it shrink relative to overall growth.
Mm-hmm.
The idea is that the strong growth in business loans kind of masks the reduction in perhaps more traditional or transactional CRE.
Shifting the risk profile.
Exactly.
Yeah.
Trading potentially more volatile CRE for growth in those diversified higher margin business lines we talked about.
Makes strategic sense. And the long-term goal for overall loan growth, once they get that CRE ratio where they want it.
Mid to high single-digit loan growth. Sustainable, but solid.
And this whole strategy, the growth, the shift, is supported by...
That strong capital position we mentioned earlier. Their best-in-class ratios.
Right, the competitive advantage. How are they thinking about deploying that capital?
Near term, the priority is clear. Organic growth.
Yeah.
Funding these new teams, these new lending verticals, putting the capital to work, building the business.
Makes sense. What about returning capital to shareholders? Buybacks, dividends?
They said they'll take another look at that. Things like share buybacks towards the end of 2025 or maybe early 2026.
What needs to happen first?
They want more clarity on how productive these new teams are, how things are shaping up. But importantly, they did acknowledge that they see the stock as undervalued.
Ah, a little signal to the market there.
A little nod, yeah. Something for investors to keep in mind.
Okay, let's quickly touch on operational guidance for Q3 expenses.
Guidance for core cash non-interest expense is about $61.5 million. That reflects bringing on those new production staff in Q2, so investing in growth.
Got it. Non-interest income.
Guided to about $10.5 million for Q3, with swap fee income around $500,000 of that.
And the tax rate.
Projected between 27% and 27.5% effective rate for Q3.
And overall balance sheet growth for the rest of the year.
Expected to be low single digits,
Yeah.
controlled growth.
Okay. Now, one specific area that always gets attention in New York, the rent-regulated loan portfolio. Any concerns there, especially with potential political changes?
Yeah, they address the potential impact of what they call the Donny Morrow win, referring to NYC political outcomes influencing rent regulations. It's something they're monitoring.
But they seem pretty confident.
They highlighted the portfolio's granularity. Average loan size is only about $2.8 million. And crucially, they have zero non-performing multifamily loans in that book right now. Zero.
That's a strong data point.
Very strong. And they added that all the loans originated before the last big law change in 2019 have already repriced and are performing. Plus, they've managed through rent freezes before.
So experienced and resilient in that specific space.
Seems to be the message, yeah. Watching, but confident.
Last piece on strategy, liquidity. They have a strong cash position. Are they buying securities?
No, not really the focus right now. The priority for deploying liquidity is putting it back into those new lending verticals and general C&I loaned commercial and industrial.
Why C&I?
Better yields, generally, and it aligns with that long-term goal of improving the net interest margin. It's about redeploying cash into higher returning assets.
Makes sense. And their loan-to-deposit ratio.
Currently around 91, 92%. They said they're comfortable in the 90, 95% range. So right in the sweet spot.
Okay, let's pull back now, put this in context for you, the listener. What does Dime's performance tell us about the broader regional banking landscape?
Well, it kind of highlights why some people are calling this a potential golden age for well-positioned regional banks.
Golden age. How so?
Compared to maybe the giant money center banks, regionals like Dime often benefit more directly from, say, a stable regulatory environment and certain interest rate dynamics. Their asset-sensitive balance sheets are key right now.
Right, that sensitivity to asset repricing we talked about.
Exactly. They're well-positioned to capitalize on the flat yield curve, and especially that upcoming wave of loan repricing is boosting margins across the sector, but Dime seems particularly leveraged to it.
Interesting. Now, the stock itself, down about 7.2% year-to-date.
Yeah, it's underperformed the S&P 500, which is up around 10.8%. And even the regional bank ETF, KRE, is basically flat, down just 0.2%.
So Dime's lagging a bit, despite the strong results and outlook.
It seems so. Analysts definitely noted the earnings and revenue beats, the strong growth, that positive NIM story. But the market reaction, as we said, was modest.
What do you think that is? Cautious optimism?
Probably. Investors likely want to see continued execution on these strategies, maybe get clearer signals on the economy before they fully buy into a re-rating of the stock.
Makes sense. But the strategy itself, diversifying into higher margin and potentially lower loss areas, plus that strong capital, that seems like a differentiator.
Absolutely. It positions them well for better risk-adjusted returns compared to peers who might be more stuck in traditional models.
Okay, time for our favorite segment, not financial advice, where we toss around some outrageous but plausible trade ideas for DCOM. Ready?
Let's hear them. Always entertaining.
Idea 1. The special dividend surprise. Think about this. They have those best-in-class capital ratios, right? CET1 over 11%, total capital near 16%.
Rock solid.
Management says the stock's undervalued. They're prioritizing organic growth now. But what if late 2025, early 2026, those new lending verticals are humming? That NIM expansion from repricing is really flowing through.
Okay.
What if management decides, okay, organic growth is covered, let's reward shareholders, and they announce a massive, unexpected special dividend, way bigger than anyone expects?
A real capital return surprise.
Exactly. A catalyst that forces the market to re-rate the stock instantly based on that tangible return. Plausible, given the capital strength.
Yes, definitely audacious.
Yeah.
But given the capital levels and their view on valuation, you can construct the argument. Plausible, yes. Outrageous, maybe a bit. I like it. What's number 2?
Idea 2, the divergence long-short play. This one's a bit more complex. You go long DCOM, maybe even leveraged.
Okay, high conviction there.
But you hedge it. You short a basket of regional banks that are still heavily reliant on old-school, undiversified commercial real estate, the ones not making the strategic shift Dime is.
Playing the gap.
Exactly. The core idea is betting on divergence. DCOM's strategic shift to higher margin, diversified stuff like fund finance, plus those repricing tailwinds, leads to significant outperformance versus the less agile peers stuck with CRE CRE headwinds and maybe regulatory pressure.
So if DCOM executes, their multiple expands while the others stagnate or shrink.
That's the bet. You're betting on Dime's strategy, winning out against the banks that haven't adapted as proactively. Smart money versus maybe stuck money.
A classic pairs trade concept applied to strategy execution.
Interesting. Both ideas definitely rely on Dime delivering on its promises.
Absolutely. Execution is everything. So let's recap. Dime Community Bank shares put up a solid Q2, beat expectations, and more importantly, laid out a really clear path toward structurally higher net interest margins.
Yeah, and that path isn't just hope. It's grounded in that significant loan repricing opportunity and their strategic push into new, higher margin lending areas.
And while the stock performance year to date hasn't maybe reflected that yet,
Management's confidence, backed by that strong capital position and the clear roadmap, really suggests there's potential for a re-rating as these catalysts play out over the coming quarters.
definitely one to watch. Now remember, this is the deep dive. Everything we've discussed today is purely for informational purposes. It is absolutely not financial advice.
Please do your own research. Consult with professionals before making any investment decisions.
So, thinking about everything we covered, what's the single most critical factor you're watching for Dime going forward? For me, it's the sustained execution on that strategic pivot. Seeing those new lending verticals ramp up effectively, seeing the NIM climb towards those targets they set, and managing the CRE reduction smoothly. It's about proving this multi-year transformation is truly taking hold.
Proving the structural transformation. Well put.
It's more than just one good quarter.
Indeed. All right, thank you for joining us for this deep dive on DCOM. We really hope you found it valuable.
We look forward to connecting with you again after the Q3 results come out.